It's been a few wild days of stock market, but now wild is getting worrisome, at least in some of the mid-cap stocks. But that's the basic nature of equities. It comes with underlying risk. Why do equity markets on a long-term basis give you better returns than bonds and fixed deposit? Is because they come with risk and volatility. 2017 was this unusual outlier year, and as I'm sure the future generation will remember 2017 as a year where volatility was so low that spoilt us. And now our 4 or 5% correction in benchmark indices looks like a financial Armageddon, but that's not the reality. The reality is that the growth cycle, the profit cycle, the global liquidity, all of them are not all that scary. So yes, markets could fall, there could be technical chop and chop, compression here and there, but that's sentiment in the short term. Like Buffett always says that in the short term, markets always are a weighing machine. It's a popularity contest, and that is what happened to the markets in 2017. Everyone got trapped because of instant gratification, quick returns were there, and now the tide is reversing. It is hurting the same investors. But is it time to be a contra buyer, or is it time to shop? That is what I think we need to really debate, discuss, and try and find answers to. And that is what I will do with Shyam Sekhar. I've always called him Mr. Contrarian. I mean, he was the first guy, I think, in 2017 who went on record and said financial stocks have not become overweight, but they become obese. Go and buy IT and pharma because they were offering good value. So Shyam, before I get into your specific recommendations, is it time to put money to work or protect your cash? This market will unwind more and we will get better entry points.
Your market's correct. There is a tendency for investors to buy the same stocks which they bought on the way up. Usually, this is how people lose. It is a time to shop selectively. I don't see merit in blindly shopping stocks which have fallen from their peaks. That is not a way to shop. So the way one shops is very, very critical now.
So what are the basic rules which you are following while shopping in this market? I mean, the selling in the mid and the small cap space, Sham, reminds me of like a 26th January Flipkart or an Amazon sale. Everything is available 15 to 30% cheap.
This sale is only the first in a series of sales. That's the basic concern. So I think that one should look beyond the immediate. Like you look at most of these companies, they're all selling at 2 times revenue, price earning multiples well in excess of 20. So you are not really able to find great value in them on their near-term earnings, that is on the next year's earnings. So essentially, if you want to shop in that space, it is going to be very, very tricky. And I find that most people are trying to shop on the basis of how much the stock has fallen from the recent high. This, in my view, is a disastrous way to do small and mid-cap investing. You should quickly realign the stock price with fresh earnings estimations of the future. I think that is something that we need to do now, and that is going to be very critical to our shopping process. On the contrary, I prefer to buy businesses which I am taking a 3 to 5 year view in the micro cap and in the small cap space. I am not looking at the mid cap space because the mid cap space seems to be over invested into, and I would only look at it when people are selling them, not now.
Morning, Shyam. I am taking a look at your Twitter page. Always love reading some of the interesting tweets that you put out. Reading one from the 7th of February, placing orders for just 100 shares of a company at regular price intervals, the thrill of waiting, getting news of execution, old world joy stay. I could easily prod and ask you which shares those were, but I won't. So give us a sense as to where you're really finding comfort right now in the markets in terms of the overall earnings trajectory, because a lot of experts we talk to say that that's going to be a key trigger. How are you looking at the overall earnings mapping up for FY 18-19? Do you think that we can see a decent recovery?
I think there should be a very decent earnings recovery in the next financial year. And I think it should be a top-down recovery. I'm not unduly worried about oil at this point in time. Though it looked scary at the beginning of the year, I think this gap may slowly lift off as the year progresses. One should watch it closely to see the trends and to analyze where the oil price is going. But my own 2 cents is it may not be too much of a worry. I think oil prices may soften a bit rather than harden. So that again will help the earnings recovery. I expect commodities to come back sharply in the next financial year. You're already seeing a number of commodity companies, especially in metals, doing well. I expect this trend to continue. The volumes are going to be strong, and metals will again gain significant share of the large cap exposure. That is something that is certain to happen in the next financial year. This year, there has been a very guarded response from institutional investors towards metal stocks. I expect the guard to lower a bit in the next financial year.
On economic recovery, both locally and globally, and if you expect metals to do well, which means that now it's time to buy commodity producers. It is time to buy companies which would gain if the economy, picks up, rather than betting on good old defensives. Are you making a case that buy banks but buy wholesale banks, buy metals but interest rate, buy wholesale banks, don't buy NBFCs, but certainly look at the banking sector in a different way?
I tend to agree with that view, Nikunj. That is broadly what I think. I think that the NPA cycle and the slippages are all slowly receding. You noticed during the last RBI governor's interaction with the media, there were no questions on slippages, which I found very interesting, because that was a point of contention every time he came and interacted with the media. This time, people didn't even mention it. And that's a good indicator. We are also seeing news flows every day on progress towards resolution of NCLT cases relating to the big metal companies. I expect that over the next 90 to 180 days, we will be putting this behind. Subsequently, I believe that the metal space is going to be far more consolidated than it ever was. And I think that this is a very good pointer towards the future. And if metals scenario improves, it is fairly straightforward to assume that the wholesale banking will also start looking up. Not only that, there may be fresh alternatives for wholesale banks to lend as well to the newer buyers of these businesses who have better balance sheets, better creditworthiness to take on those loans. So I think wholesale banking as a pack looks good.
Shyam, we always tend to amplify and focus extensively on what to buy, and the Hindi term is kya lene ka. Let's switch sides. What should one not buy in this market? Like Buffett says, that rule number 1 is that you should not lose money in stock market, and rule number 2, never forget rule number 1, because if you buy your junk stocks or low quality stocks, the risk of losing money in this kind of a market could be very high.
See, insofar as the market favorites of the last year, I think one should be very, very careful, because I think many of these companies have seen multiple expansions based on factors which are more short-term oriented, demand supply mismatches and stuff like that. Companies like that should be viewed very, very carefully. I think that whenever we give multiples, it is an indication that we expect the earnings growth to sustain for a much longer time to come. But that caution has been thrown to the winds in 2017 because the flows from domestic investors has been so strong, and the pressure to show NAV growth has also been at its peak in our mutual fund history. So I think that there has been a lot of indiscretion in the way we have institutionally procured mid-cap shares. So I think one should be very careful in what we buy in the mid-cap space. I am basically very cautious on some parts, and I have no hesitation in naming them. First, carbon stocks. Second, microfinance. Third, housing finance companies. Fourth, NBFCs. These are some of the spaces where I think one should be very, very careful. You should subject those companies' earnings to continuous stress tests. Something happening somewhere remotely can affect these businesses. I am of the view that lending businesses are yet to factor in a technological disruption created by Aadhaar. Once the Supreme Court puts the Aadhaar debate behind, I am of the view that a lot of retail lending is going to become commoditized, and that will open the doors to banks. And I believe that going forward over a 3 to 5 year view, personal credit is going to be measured far more acutely than it ever was, which means that knowledge of the customer is not going to be such a difficult thing or a moat. So lending businesses are likely to be transformed significantly and commoditized in that process. So that is something that we need to look ahead.
That's a view coming in on the sectors that you're going to avoid right now. How are you looking at the overall pharmaceutical space, given the kind of earnings that we've seen? You haven't seen some sort of a material recovery, and I think that the sense that a lot of investors have across the board is that one is remaining a little bit circumspect on the space until things really clear out. How are you positioning yourself, or what are you advising rather, when it comes to pharma?
See, I have been watching pharma quite intently. It went through a phase of, having these US FDA scares. A series of them affected several companies. Then you had all those, alerts being given. I think that cycle is receding and it's on the way out. Companies have learned to manage their systems far better, and I believe that the US FDA is also being proactive in releasing companies from all its notices of the past. But there is an issue of companies' profitability in the US markets that is still an overhang. I believe that over a period of time, this will be addressed by the companies which have the ability to bring more products to market. So I think that doing more in that market is what will release companies from the pressure of lower revenues and consequently lower profits. So I think that we are now going into a positive cycle. It may be early days yet, but considering that it is a defensive space and there is going to be a lot of fear in the calendar year 2018 in global and Indian markets, there will be a lot of money that moves towards pharma. I would like to invest on a graded basis. As the news flows start improving, I would definitely scale up pharma. That would be my approach to pharma.
True to his word, or true to the expectation, really, Shyam, we did see quite a bit of trust being given to the agricultural sector in the budget. It brought that sector to the forefront, very focused on education, healthcare, as well as agriculture. Give us a sense as to what your outlook is, and you believe that this is a promising space, agri-inputs?
The whole agri value chain looks like a very good long-term story. If you look at it from a 3 to 5 year perspective, I expect farm incomes to go up, and I expect a number of industries to come downstream as well, and you will see a value chain getting established. I expect the cold chain businesses to take off in a big way over the next 3 to 5 years. So I think that the agri space offers a number of parts of a value chain. There are a number of opportunities to choose from each part of this value chain. Inputs is an obvious part, but if you look at how we viewed inputs, it was all based on the subsidies and other things in the past. I think that efficiency will be the key driver going forward. Businesses which are run more efficiently will tend to be those that create shareholder value. So I think the businesses that are not efficiently run in the agri-input chain may not be the ones that will benefit. And there are numerous ways of playing this, and I am very, very bullish on the agri-input chain. In fact, that is my most important focus area for the next year.
The mystery of what is going on continues. I'm not talking about the news, I'm talking about the price action. 10% uptick is there in Vakrangi, which means it was first 5% lower and now 5% higher. It's a 5% circuit limit for Vakrangi, so it was first locked down and now it is locked up. Markets are delighted to see the back of Singh brothers, aren't they? Fortis is up 8%, but for those who are buying Fortis, with the assumption that Singh brothers are out and the stake sale would be done, I don't think so. We should look at it like this, because they still own shares, and the complete transfer will only happen when the shareholders are able to sell their equity in the company. And the Supreme Court has barred Singh brothers from selling any ownership till the time they don't settle their case with Daiichi. So I don't think we should get excited about the price action in Fortis. Fortis is an F&O stock, so sentiment and other things take over in the short term, but I'm simply putting facts on the table. The third stock which I want to point out, and what Shyam was just referring to, Tata Steel and Vedanta. These stocks are up from the day's low. So the market is not looking all that broken down. You look at the index and you say, okay, 4% fall in Dow, world is going to end. No, it does not work like this. Indian markets have corrected. We are on a different cusp of earnings cycle when it comes to globe versus India. Globally, the earnings cycle, if not peaked out, is peaking out in 6 to 12 months. In India, we are on cusp of a very big economic recovery. For the first time after a gap of 9 or 10 quarters, we will get earnings upgrade. 3 out of 4 Nifty companies which have come out with numbers today, I mean, I'm just putting that as a mathematical number, 66% of the Nifty 50 companies so far which have come out with numbers have surprised. So Shyam, let's go back to this very basic question, because everyone seems to be, tweeting about it and asking me the same question. Is this 2018 making? Why do you think this is not 2018 making? I've expressed my thoughts 15 minutes ago. Let me hear your thoughts.
No, I don't believe that this is 2008, because in 2008 the index was overvalued, more extensively than it is today. And if you look at what has happened to the index, though your index PE looks amplified, you remove the private banks and then you look at the valuations of the index, it doesn't look all that scary. And I believe that this earnings upgrade cycle that you mentioned will continue through the year. I don't think that this is one quarter. I think that you will have at least one more upgrade in the calendar year. So I think that the earnings valuations will soften. But what can be different from last year is that I believe that you could have healthy corrections, because last year I think markets just went up one way. We would not have that kind of strength in the markets in 2018. 2008 was different, because I think in 2008 you had a combination of several factors. You had business leveraging very extensively. Today the leverage is the lowest among corporate India. So I think that the comparison at 2008 may be a bit extended. I think that with such low leverage, we should not really call the market run to a close. I won't do that. But I think that one should be very stock specific, sector specific, and we should look at the leverage in companies very carefully. And I believe that this trade towards companies which have a fairly predictable earnings, like your HDFC Bank or all your private banks or your HFCs like HDFC, I think that's more or less a done thing. I believe that the trade will migrate towards risk in this year, and that will happen with a lot of price movements. So it's going to be a very volatile year, but it's a year when a lot of opportunities will open up. One should look beyond the companies that have performed well in 2017. One should closely scrutinize the companies which are either heading into an earnings upgrade or have just got an upgrade. I think that this is a year to do a lot of homework. That's what I would say.
On TV, that volatility does not mean risk. Volatility for a long-term investor always creates a great entry point, because if markets are not volatile, then the basic definition of equity as an asset class will change. In the short term, markets are always moving because of sentiment. Today, the sentiment is sour, but the sentiment will improve. A year ago, we were only talking about demonetization. That's forgotten history. 6 months ago, we were talking about GST. That's a forgotten story. Today, we are talking about global cues. And trust me, if things stabilize, that also will be a forgotten story. So, Shyam, closing comments from you. What we're trying to attempt here, Shyam, is trying to put out 5 topics of today's discussion, and I'll make a Twitter plate out of it. I've got 4 points from you already. The 5th point has to be something stock specific. So let's talk about the 5th point. What is there on Shyam Sekhar's radar in terms of a large cap or a mid cap idea?
Large cap, I am looking to buy one good metal stock. I'm just looking at, there are very few choices, so it's fairly simple. In the case of Tisco, there is a rights issue. I would like to see where it stabilizes post that dilution, and you have sale. So it's not very difficult to see where to choose. I have not bought much, but I am still studying that so that I could, scale up my position and use the volatility to buy into one metal stock. Midcap, I think that is a difficult space, and I'm basically not looking at midcap at this point in time. I'm more looking towards selling midcaps because I find that a lot of stocks are being supported by the institutional investors by their SIP flows. So, whereas the valuations don't support. So, it is only the money that is supporting. I would only look to sell. So, I would not really look at naming a midcap stock. My buying is mostly in the micro cap space, so I think it's too illiquid and it would lead to speculative moves, which I would not like to create through my utterances. So you must excuse me from naming a micro cap.
Okay, we've got that done and we shall go ahead and make that Twitter plate as well. Pleasure chatting with you. Thank you so much, Shyam, for joining in and giving us your overall perspective. You've been fairly frank as to what you would avoid buying in the markets as well as where you see potential corrections, your outlook on valuations and the flows as well.